So good afternoon, everyone. Thank you for joining today's session. My name is James Papadopoulos, and I'm the head of Americas at Fitch Learning. It is my pleasure to welcome you to our discussion today on Covenants 101, Decoding Bond and Loan Covenants. Now, before we dive into today's topic, let me briefly introduce Fitch Learning. We are part of the Fitch Group, which includes Fitch Ratings and Fitch Solutions. We are a leading provider of training and development solutions committed to enhancing the skills and knowledge of professionals across the finance industry. Additionally, we are supported by the Global Institute of Credit Professionals, which serves as a community for credit professionals worldwide to achieve certification in credit, to network, and to further their expertise, and are sponsors of today's session. I am delighted to be joined today by two of my esteemed colleagues from Fitch Solutions' Covenant Review, Scott Josephberg and Ian Feng. Together, we will explore the intricacies of bond and loan covenants, providing insights and practical guidance to help you navigate the critical aspects of finance. As we proceed with the presentation, I encourage you to actively participate by sending your questions via the Q&A chat feature. Our panelists will address your queries during the Q&A segment. We look forward to engaging with you today and providing valuable information that will assist you in your professional journey. So with that said, thank you for joining us, and we can get started.
Thanks, James. My name is Scott Josephsberg. I'm head of high yield research for Covenant Review. And with me is my colleague, Ian Feng, a senior loan covenant analyst for Covenant Review. Ian and I are both attorneys who spent many years in big law negotiating credit agreements and indentures for underwriters and issuers before we joined Covenant Review. At Covenant Review, we aim to take the mystery out of these provisions and translate the legalese so that everyone can understand what's going on in bond and loan covenants. These are extremely complicated provisions, and the devil is in the details. What we're going to try to do today is go through the most important bond and loan covenants, explain why they're there, how they work, and where the pitfalls are. But first, we're going to jump into just a little bit of the difference between bonds and loans. For the most part, bonds and loan covenants cover the same ground, but sometimes in slightly different ways. The key differences between bonds and loans are bonds are securities, loans are not. Although loans also trade, loans are not securities because there are court cases that say loans are not securities. The biggest import of that distinction is that bonds are generally freely transferable. And while loans might have blacklists or whitelists, generally speaking, an issuer cannot control who owns their bonds, who invests in their bonds, or who trades in their bonds. Typically speaking, bonds are not subject to the same type of pro rata treatment rules that loans are. We'll talk about this a little more towards the end of the presentation, but this has been an issue in some recent liability management transactions, particularly with the recent court decision in CERTA and similar up-tiering transactions where some creditors are treated more favorably than others in an exchange situation or other liability management transaction type scenario. Additionally, bonds typically have robust call protection where loans have much more limited call protection. Now, by call protection, what we mean, of course, is a loan is freely prepayable generally, but a bond typically requires a call premium for the issuer to repay the bond early. For some period of time, that's typically the make-whole, meant to compensate the investor for the present value of not only the face amount of the bond, but all the interest payments through the first call date. And then after some date, the bonds will hit a call schedule, which is a schedule of predetermined declining call premiums. Last big difference between bonds and loans is bonds typically have a fixed rate coupon where loans are typically floating rate. Which is better depends on your point of view and where interest rates are at the time.
All right, thanks, Scott. Next, we'll just talk about what are covenants. Well, covenants are essentially a promise by the company to do something or not do something. If it's something that they're promising to do, we call that an affirmative covenant. And if it's something they're promising not to do, we call that a negative covenant. The covenants are needed because, unlike equity, debt is not subject to any sort of protections from fiduciary duties owed to those creditors. So, whereas a borrower might owe a fiduciary duty to its equity holders or shareholders, it does not need to do. It does not have that right duty to its bondholders or lenders. Therefore, lenders and bondholders must bargain for their own protections, and that's where the negative covenants come in. So what are the ones that we're going to be, what are the ones that we are going to be talking about today? Well, the main ones typically will revolve around what the company can and cannot do in terms of the incurrence of debt or the movement of money. So we'll talk about how negative covenants might limit the incurrence of additional debt, the incurrence of additional liens, which is really talking about secured debt, whether or not a company can make restricted payments, and we'll talk about what that actually means. Whether or not a change of control will trigger any sort of repayment of the underlying debt instrument. This is actually a little bit different between how bonds and loans treat this particular issue, so we'll get into that as well. And lastly, we'll talk about the asset sales covenant, which is perhaps a little bit of a misnomer because it's much broader than pure asset sales. It's going to be really talking about the ability of a company to transfer assets in general, whether that's through a sale or through some other mechanism. When it comes to covenants, one principal feature that we do need to really hammer in is that covenants are meant to be independent of one another. Well, what does that mean? It means that if you're looking at a particular transaction, you want to see whether or not it's permitted under the covenants. Just because it's permitted under one of the negative covenants does not mean that it's automatically permitted under another covenant. Perfect example of this would be the incurrence of secured debt. This might implicate both the debt covenant and the liens covenant. And if it's permitted under one, it needs to be independently permitted under the other. Just because it's permitted under the debt covenant does not necessarily mean it is permitted under the liens covenant. Things get even more complicated if you take more complicated transactions like a dividend recapitalization, in which case restricted payments covenant and issues are going to come in, or asset sales of particular parts of the business, in which case you have to look at the asset sales covenant. So just keep in mind that it's not a simple analysis when it comes to analyzing covenant protections. You really do have to have a firm grasp of what a transaction is and is not, and which negative covenants might get implicated by that particular transaction. So we'll start with the debt covenant. Very simply, it is a limitation on the incurrence of future debt that a company is allowed to incur, or a company or its subsidiaries, if we want to be specific about it. The basics is that there's a broad prohibition. It's in the beginning of each covenant, it'll say something along the lines of, well, the issuer and the borrower and its subsidiaries are not allowed to incur indebtedness. And that will typically be a defined term, and you'll need to double check what that means, but often it refers to things like debt for borrowed money, capital lease obligations, disqualified stock, and other similar instruments. Beyond the overarching prohibition will be a number of carve-outs or exceptions, which are typically referred to as baskets. In leveraged finance, particularly high-yield bonds and broadly syndicated loans, these types of baskets tend to fall into two main categories. The first is a ratio or incurrence test, which tests a particular financial metric upon the incurrence of the debt. And the second is a dollar-capped basket, which is what it sounds like, a specific carve-out up to a negotiated dollar amount. One thing to keep in mind for all baskets, and this is true for all negative covenants, is that these baskets are going to be additive. What does that mean? It means that just because you can incur debt up to the ratio in a ratio test does not mean that there are no other options available to the company. They can always add on to that using other baskets. So you have to think about these baskets as a whole and think about how they can be added together or combined in various ways. So specifically in terms of ratio tests, there are usually two kinds. In traditional high yield indentures, the ratio debt carve-out was typically tied to a coverage ratio, which was often EBITDA to interest expense or fixed charges. So you'll see Typically, this would be a 2 times interest coverage or fixed charge coverage test. In broadly syndicated loans, this was more traditionally a leverage test, so some sort of testing debt to EBITDA. Now, that could be first lien debt, secured debt, or total debt, depending on the situation. One thing to keep in mind when it comes to all covenants is that there's often going to be references to EBITDA, including in the dollar cap baskets, where there's often an EBITDA-based grower. Just because you see EBITDA being disclosed by the company, you need to remember EBITDA and covenant EBITDA can be very, very different. That is because EBITDA, as disclosed by a company, might not include all of the add backs that are permitted in EBITDA as negotiated in the underlying credit agreement or indenture.
And just to put a finer point on something you mentioned there, Ian, each of these carve-outs are separate and cumulative to each other. So what that means or one of the important things that means in context is that where you see a ratio test, such as in the debt covenant, like a coverage ratio test or a leverage ratio test that Ian mentioned, that ratio test is not a cap on the issuer's ability to incur debt. So let's say, for example, the debt covenant allows the issuer to incur debt so long as leverage is not greater than 4 times, just to pick a number. That doesn't mean that if the issuer is above 4 times that it's in default, nor does it mean that if the issuer is above 4 times that it cannot incur more debt. That 4 times test is but one carve out under the debt covenant. And in addition to that 4 times test, there are going to be a whole litany of other baskets that the issuer may have access to. And that's why we say each of them is independent. Not having access to the 4 times ratio test basket does not mean that the other carve-outs are not available. So in a high yield bond, the most important debt covenant carve-out is almost always permitted debt clause number 1, and it's what we call the credit facilities basket. And I say it's the most important because it is almost always the largest and most important carve-out. It is designed to accommodate debt typically that primes the bonds. So you'll see this basket that is allowed to be secured that will be sized to accommodate the issuer's issue date, term loan that may be drawn on that date, the issuer's revolver that exists on the issue date, including any undrawn commitments under that revolver. If there's an accordion feature under the credit facilities, under the issuer's credit agreement, the credit facilities basket is going to allow that. And there's probably some headroom as well built into that basket. So this is always the largest and most important basket. It's almost always permitted debt clause number 1. And the only other thing I would say about that is, although we call it the credit facilities basket, that's sort of the historical way of referring to it. Often, as I mentioned at the beginning of the presentation, the devil is in the details on these things. Definitions don't always mean what they sound like. And credit facilities does not mean credit facilities. Credit facilities means any kind of debt. So typically, this is just a large general purpose use basket for priming debt that accommodates the issue date credit agreement and perhaps some additional debt as well.
And I would just add that the credit facilities basket is primarily a bond feature. You will typically not see a credit facilities basket in a credit agreement. I say typically because there's definitely examples out there that do use that construct, but for the most part, because credit agreements, and particularly the broadly syndicated loan market, we're talking about first lien, term loan, or revolving debt. It's much less of an issue in terms of how much additional priming debt is going to be incurred. It's really about what is the dilution of that first lien on that collateral asset. So the focus is much more about specific carve-outs, specific baskets, and in the broadly syndicated loan market, that's often going to be in the form of the accordion. In fact, if you look at a bond and a loan from the same issuer, the credit facilities basket is often structured so as to permit the credit agreement and any future incrementals under that accordion. And by accordion, I am referring to a particular feature in most credit agreements that allow for the incurrence of additional pari passu first lien debt under the same credit agreement. It's not committed financing. It's just built in capacity to incur that additional debt.
Yeah, great point, Ian. And I would just hammer home again, these carve-outs are cumulative, so you can't stop at the ratio test. You can't stop at the credit facilities basket. Other important baskets will typically include a general debt basket that will allow some additional incremental capacity. And then there will be some specific purpose use baskets as well, often a finance lease, a purchase money obligations basket, sometimes a non-guarantor debt basket, sometimes a foreign subsidiaries debt basket, sometimes there are baskets for securitizations and the like. And again, each of these are cumulative to each other. So we have to go through all of them to think about what's the maximum amount of additional debt that the issuer can add after the issue date. Next, we're going to go on to the liens covenant, and I would pause here again to reiterate another point that Ian previously raised, and that is that each of the covenants operate separate and independently of each other. And the reason that I remind folks of it here is because the debt and liens covenants, while they address related concepts, operate independently. So the debt covenant governs the incurrences of debt, and the liens covenant governs the incurrences of liens that secure debt. So as Ian mentioned, it's not enough that there's a debt basket. It's not enough that there is a liens basket. If an issuer wants to incur secured debt, there has to be permission under both covenants. There has to be a permission to incur the debt under the debt covenant, and there has to be permission to incur a lien securing that debt under the liens covenant. So generally speaking, from a high yield bonds perspective, the purpose of a liens covenant is to preserve the relative ranking of the bonds within the capital structure. Now, the reason I say that is because we see two main types of liens covenants, and which one is used depends on if the bond is secured or unsecured. You may sometimes hear people refer to an equal and rateable pledge or a negative pledge covenant. And that's just sort of loose language for a form of the liens covenant. And this is the kind of lien covenant that you would typically see in an unsecured bond. What a negative pledge lien covenant says is that an issuer is not allowed to incur liens, the general rule, just like Ian mentioned for the debt covenant. The issuer is not allowed to incur liens except for permitted liens. Permitted liens are the carve-outs. Just like in the debt covenant, there's a broad general rule and then a lot of carve-outs. But the negative pledge will have an additional broad exception. It will say, unless the bonds are equally and rateably secured. So why is that language there, and what does it mean? So let's say you're an investor in an unsecured bond. Typically, if there's a liens basket and the issuer uses it to secure the next deal, that next deal is going to prime you because that deal is secured and you're in unsecured debt. So you're effectively subordinated to the secured debt to the extent of the collateral. But let's say instead the issuer does not have any available liens baskets capacity. So the next deal comes along and they want to secure that deal. So what the negative pledge says, equally and rateably secured, is they could take the unsecured bond that you have and they can give you equal and rateable security as the new debt is getting. So instead of getting primed by the new debt, you're pari with the new debt. The thought being an unsecured investor shouldn't care if some new debt gets security if they get the same security on the same basis. So the purpose of the negative pledge there is to preserve the relative ranking within the structure of the two pieces of debt. On the other hand, we have a true liens covenant. A true liens covenant is the same without the negative pledge language. So the issuer is not allowed to incur liens except permitted liens. A negative pledge would be completely inappropriate for a secured bond, because in a secured bond, if you had a negative pledge, what that would basically be allowing is every deal behind you to get the same collateral on the same basis, because giving someone else the same collateral on the same basis would be equal and rateable with what you have. So that's actually a big flaw, usually a drafting bust, that we look out for in secured bonds, particularly when you have a repeat issuer who's done a bunch of unsecured bonds and then they go to secured bonds, because from a drafting point of view, usually what the attorneys do is start with the old indenture and then make changes to account for the new deal. And this is a point that sometimes gets missed or overlooked, and it's a big, big thing for secured holders. Anything you want to add on liens covenants, Ian?
Sure. So from the loan perspective, it's very similar to bonds. You don't typically see negative pledges because loans in the BSL market and private credit are usually first lien secured. So equally and ratably secured protection is mostly not needed. The one exception is in some deals, you'll see this kind of negative pledge language specifically for liens on non-collateral assets. So assets that do not currently secure the debt instrument. If a lien secures those kinds of instruments, then you might see a springing lien that says, well, you also have to secure the credit agreement debt equally and ratably with that new debt on those non-collateral assets. But for the most part, you're going to see just true liens type covenants in credit agreements. One other thing to keep in mind is because the perspective is slightly different, if you're a credit agreement investor, chances are you're a first lien lender. You're really looking at protections in terms of where you sit in the priority of the overall capital structure. So liens covenants are much more about how much dilution is possible as opposed to how much priming is possible. Now, that's actually a very nuanced point because I think a lot of new investors or investors who maybe are not familiar with covenants will think that the liens covenant is also there to provide for some sort of fixed amount of priming capacity. At least in most broadly syndicated loan credit agreements, that's not true. The liens covenant typically does not build in capacity to prime existing first lien debt. Chances are that's going to be an amendments question. It's going to be about how many existing creditors or lenders under the credit agreement are needed in order to allow for subordination of what used to be first lien debt. So there's usually not a basket for super priority debt. It's really about, is there a minimum threshold of creditor cooperation that is needed in order to prime everybody who's currently first lien?
Yeah, great points, Ian. And just briefly to talk about some of the carve-outs to the liens covenant, the lingo here is the carve-outs are called permitted liens. Many of the permitted liens carve-outs are drafted as simple cross-references to the debt covenant. So again, for debt to be secured, there has to be a liens covenant permission for it to be secured. So I mentioned on the debt covenant, for a bond, the most important debt covenant carve-out is the credit facilities basket. There's typically a permitted lien that says that permits lien securing debt incurred under permitted debt clause number 1. Just a cross-reference says if the issuer incurred debt under that basket, it's allowed to be secured. A number of other liens carve-outs might work like that. There is sometimes a permitted liens carve-out allowing debt under the general debt basket to be secured. Sometimes there is, sometimes there isn't. There are often some other specific use liens carve-outs, just like under the debt covenant. And there is almost always a general liens basket, just some amount of debt that's allowed to be secured in addition to all of the other carve-outs. One other important carve-out is many permitted liens definitions have a secured leverage ratio based carve-out. Just like under the debt covenant, if there's a secured leverage ratio test in the liens covenant, it is not a cap on secured debt. So just to use the same made-up number, same made-up example, let's say there's a permitted lien that allows lien securing debt so long as secured leverage would not be greater than 4 times. If secured leverage is greater than 4 times, it doesn't mean the issuer is in default. It doesn't mean the issuer can incur more secured debt. It just means that that one carve-out is not available. So I'll say again, the most important thing that I think any folks that are new to this stuff can take away from a Covenants 101 presentation, it's that these carve-outs are separate and cumulative to each other. as Ian mentioned at the beginning of the presentation, these are incurrence-based covenants. So if you have that ratio test, like we made up in our example, 4 times secured leverage, not a maintenance covenant, doesn't mean the issuer is in default if they can't meet it, just means that one carve-out is not available. Next, we'll move on to the restricted payments covenant. The restricted payments covenant, I think, is the most important and most difficult to understand of the big 3 covenants. And by the big 3 covenants, I mean debt, liens, and RP. The restricted payments covenant has a little bit of a different structure in bonds than it does in loans. I'll briefly go over the bond structure, and then Ian will jump in with the loans. So in a typical high yield bond, the restricted payments definition, what is a restricted payment, what the covenant covers, includes 4 prongs. 1 is dividends, 2 is stock repurchases, so we can kind of think of those prongs together as payments to equity. 2 is prepayments of certain kinds of junior debt. And number 4 is investments in entities outside of the restricted group. So I will say briefly that although junior debt prepayment is part of the restricted payments covenant, it is mostly meaningless. Typically, whether you're in an unsecured bond or a secured bond, the junior debt prepayment restriction will apply only to contractually subordinated debt. Contractually subordinated debt is, for the most part, functionally extinct. And what I mean by this is debt that is fully subordinated, payment subordinated. You'll know it when you see it because it's in the name of the bond. It's bonds called senior subordinated notes. You almost never see them anymore. And so typically, this restriction won't mean anything. Now, the import of that is that junior debt prepayment restrictions aren't really present and don't really work. So you might have financing where first lien bonds and unsecured bonds are being issued at the same time. And in that structure, typically, the secured bonds will also have temporal seniority. Seniority in terms of where they mature. They'll mature a year before the unsecured bonds do. And so you would hope, what you would want is for there to be a restriction on prepaying that unsecured debt ahead of the secured debt. Unfortunately, in the vast majority of deals, that protection simply isn't there. So if the issuer has cash on hand from operations, for example, it can buy the unsecured bonds in the open market, if that's what makes sense for the issuer, ahead of those secured bonds. And now an easy way to think about the restricted payments covenant is it's about keeping value in the box. The idea of the restricted payments covenant is supposed to be to keep value in the restricted group so that the restricted group can repay the debt. So the reason I bring up this graphic is because we don't just mean payments to equity. It's easy to understand that restricted payments include dividends and stock buybacks and the like. But generally speaking, it also includes other transfers of value outside of the restricted group. So if we use this diagram as an example, we see there's an unrestricted subsidiary in the bottom left. That's below and outside of the restricted group. So in a high yield bond, typically moving value into that unrestricted subsidiary, whether in the form of cash or valuable assets, would be a restricted payment. Similarly, up and on top of the restricted group in this diagram, we see a holding company, a holdco. And that holding company has debt, holdco PIK notes. What we mean by holdco notes is debt issued by the holding company that isn't guaranteed by any entities within the restricted group. So let's say the issuer were to incur debt, take those proceeds, and dividend the proceeds to the holdco so that the holdco could pay off the holdco notes. Well, that's pretty obviously an RP. The issuer paid a dividend from the issuer to the holdco. Money, cash left the restricted group. It's an RP. But let's change that hypothetical just a little bit. And let's say instead the issuer makes an exchange offer to issue new debt of the issuer in exchange for the holdco notes. Now, no cash has crossed that dotted line, denoting the restricted group, but there has been a transfer of value. A debt obligation that was formerly a debt obligation of the holdco is going to become a debt obligation of the issuer. That's effectively the same transaction as the issuer incurring the debt for new money and dividend to get to the holdco. So that too is a restricted payment. Ian, you want to jump in on RPs on loans?
Sure. I think you did a great job on the bonds, and quite frankly, it is the same in loans. It's really just a question about nomenclature. When you look at a loan, you'll often see the term restricted payment, and really in that loan, it's only going to refer to those first two categories. So when you see restricted payment for a loan, it's often limited to dividends and stock repurchases. That doesn't mean that everything else is permitted, however. Instead, you have separate covenants for investments and junior debt repayments. Taken together, that's the same thing as having one big covenant covering all four types of transactions. Instead, in loans, you just happen to have three instead of one. The baskets also tend to be the same, or at least very similar. One of the unfortunate aspects of the leveraged finance market over the last, let's say, 15, 20 years is what we call the bondification of loans, in that loan covenants start to look more and more like bond covenants. So picking up a credit agreement, you'll often see it structured or written as if it were an indenture and defining restricted payment as one of these four things. But again, it doesn't really matter. The effect of the three covenants versus the one is the same. It's supposed to protect the lenders or value leakage or value transfers outside of the restricted group. One thing to know is the reason we call it the restricted group is that those are the entities that are subject to the covenants. So from a creditor perspective, you want as many people in that restricted group because those are the guys that you actually know what they can and cannot do, because they're going to be subject to the limitations imposed by the debt covenant and the liens covenant and the investments covenant. Even if it's not a guarantor, it still has to comply with the negative covenants under the indenture or credit agreement or both. That's why we call it the restricted group. And similarly, the unrestricted subsidiary is restricted because it is not subject to the covenants. The other aspect here is the question about financial calculations. If you're an entity within the restricted group, your EBITDA will be counted for leverage purposes, as will your debt. If you're unrestricted, that usually isn't the case. The EBITDA is neither counted nor is the debt at the unrestricted subsidiary. The other aspect I wanted to touch on that Scott mentioned is the junior debt repayments covenant. Just like with secured bonds, where it's often flawed, it's also flawed in most broadly syndicated loan credit agreements. And again, that's purely a function of the bondification of loans. From the perspective of an unsecured note holder, junior debt is usually just payment subordinated debt. But from a first lien credit agreement lender's perspective, junior debt should also include the unsecured note holders as well as second lien debt. And unfortunately, for a lot of credit agreements, those kinds of instruments are not considered junior financing, or simply because they're not defined as such in the document. That can result in some absurdities, including, oh, you can prepay your second lien term loan ahead of the first lien at any time, or you can prepay or redeem any senior unsecured notes, even if they mature 3, 4, 5 years after the term loan. So I often refer to the junior debt prepayments covenant as essentially vestigial. It's there, but it doesn't really do anything.
As a longtime high yield practitioner, I actually find the term bondification of loan covenants quite amusing. It's not that bond covenants or loan covenants are better or worse than the other. It's that historically they served different purposes. There is, in broad strokes, a trend of bond covenants being somewhat looser than loan covenants. And again, broadly speaking, that's because historically, bonds were designed to be the junior debt in the structure. Historically speaking, bonds were senior subordinated, and then they were senior unsecured. And it's only sort of relatively recently, not recent, but as far as history goes, relatively recent, that we really see secured bonds becoming more and more prevalent. Certainly now with higher interest rates, it's a little different, but in the previous regime of lower interest rates and bonds having fixed coupons, we started to see more and more issuers issuing secured bonds, particularly first lien bonds, sometimes in the place of the first lien term loan would usually sit, to be there as the term debt to lock in a low rate. And unfortunately, many of the aspects in which bond covenants were looser than traditional loan covenants were not really adjusted to account for the bonds now sitting in a secured position. So that's why you still see bond covenants sometimes looser than loan covenants. And that's why longtime loan guys like Ian often joke about the bondification of loan covenants. On the next slide, we'll move on to the change of control covenant. This is an area where how the bonds work and how the loans work really do differ. In a typical high yield bond covenant package, upon a change of control, the bondholders have a put right at 101, meaning if a change of control occurs, bondholders have the right to sell their bonds back to the company at 101, a small premium. The idea behind change of control being investors invested not only in the company, but also in its management team and the equity holders' vision. And if those things change, then the bondholder should have the ability to exit the investment, including a small premium. And historically, the reason for there being a premium being at 101 instead of par is because bonds are fixed rate securities with call protection. So you don't get the full call protection, you only get the 1%. In loans, on the other hand, if a change of control occurs, it's an event of default. And events of default would typically require prepayment of the loans at par, unless, of course, the loan is amended to allow the change of control. Typically, what is a change of control will work generally the same way between bonds and loans. The change of control definition will have what we call triggers. So what events will trigger a change of control under the bond or the loan? The most important trigger is what we refer to as the beneficial ownership trigger. In other words, if ownership of the company changes, there should be a change of control. Makes sense. But what that trigger will specifically say is if a holder who is not a permitted holder acquires majority voting control of the company, that's a change of control. Now, I mentioned the term permitted holders. Permitted holders is a defined term used in the change of control definition that refers to entities that are pre-agreed to, that are allowed to be equity holders of the company. So the sponsor on the issue date, any co-investors on the issue date, management as of the issue date. If it's a family held business or was a family held business and some of those folks are still in some of the equity, they'll probably be permitted holders as well. So this might mean that management buyouts are often permitted, or if previous equity holders who rolled some of their equity want to do another buyout of the company, that's permitted, right? So we look at the list of permitted holders to determine whether a change of control has happened. Other triggers include a sale of substantially all assets. What is substantially all? Nobody really knows. There is no bright line rule for what is substantially all under New York law. It is a facts and circumstances determination, which is really just a fancy way for court saying, we don't know, we'll look at it on a case-by-case basis. Really, you look at all the factors, including how much revenue has been transferred versus left behind, what percentage of the assets has been transferred versus left behind, how much EBITDA transfer versus left behind, future prospects of the company. Anything you can think of can be used to make arguments for or against substantially all. Merger of two public companies. So this is a trigger that has fallen out of favor. It used to be that the simple act of a legal merger would be a change of control. Most of the time, that is not a trigger anymore. So the reason we talk about a merger of two public companies is often a merger of two public companies will not be a change of control. If two companies merge and the resulting ownership is widely dispersed public shareholders, that's not going to be a change of control because there's not going to be a new investor coming in that owns majority voting control of the company. Also, historically, there used to be a continuing directors trigger, which would say if a majority of the board was not continuing directors, that would be a change of control. This trigger has also fallen away because of case law. There was some Delaware case law that said basically if there's a hostile takeover, the directors being ousted have a fiduciary duty to the shareholders to approve the incoming directors for the purpose of avoiding triggering a change of control under the debt documents, because the change of control will cost the company money, and that's not in the best interest of the equity holders. The directors owe their fiduciary duty to the equity holders, and the continuing directors trigger historically always had an exception for directors approved by a majority of the continuing directors. So because that trigger just doesn't work, and under Delaware case law, the outgoing directors actually have fiduciary duty to avoid the trigger, you don't see it anymore. There is sometimes a ratings condition. This would be typical in investment grade bonds, but has started to bleed over into high yield. And what the ratings condition will say is even if a defined change of control has occurred, investors are not entitled to the put right unless there is also a ratings decline. Now, there's also some detail involved in that one that varies from deal to deal, whether the ratings decline has to be by one rating agency or two rating agencies, and what time period the decline has to occur in varies from deal to deal. And we also sometimes see what we call portability. This is very, very rare in the US and only in the most aggressive sponsor deals. But this exception will say, even if there is a change of control, so long as leverage doesn't exceed some set threshold, there will not be a change of control. So regardless of who the new owners are, regardless of beneficial ownership, so long as a leverage test is met, there won't be a change of control. And again, that's only in the most aggressive sponsor deals these days.
Yeah, and I would just add the only other aspect here that wasn't mentioned is that especially in broadly syndicated loan credit agreements, the change of control trigger for beneficial ownership shifts between when the company is private and if an IPO occurs. If an IPO hasn't occurred yet, it's the same majority control. If an IPO has occurred, then the trigger changes to be if a third party that's not a permitted holder acquires more than a specific threshold of the voting interest of the company, usually 35%, then that's the change of control. So it's really about, is there going to be one new entity or a parent that controls a chunk of the business that's big enough to constitute a change of control? That also means, and this is an important point to consider, that IPOs are not change of control. Almost never will an IPO be a change of control. It just changes what the trigger looks like under the change of control.
You know, that's a good point, Ian. And we used to see that in bonds as well, but it's fallen away. We almost never see that in high yield bonds anymore. And what that means is even absent an IPO, typically for a high yield bond, the sponsor just selling down their position is not a change of control. We're always focused on, at least from the high yield bond perspective, we're always focused on, is there a new control holder coming in?
I'll be quick on this one because I want to save time for questions. The asset sales covenant, like all the other negative covenants, there's a broad prohibition against a particular action, in this case, the transfer of assets. It's called an asset sale, but it doesn't have to be an asset sale. It just has to be the disposition of value to another party. In both bonds and loans, you'll typically have what we call a general basket, and this allows for essentially any asset sale, so long as the sale is for at least fair market value. and at least 75% of the consideration has to be in the form of cash. Again, like Scott mentioned, devil's in the details. There's going to be all these exceptions to what is considered cash, so you'll have to pay attention to what that actually is. But that's the way it's going to work in most deals. What does differ between bonds and loans for asset sales is what happens after an asset sale occurs. For bonds, there's usually a par offer to redeem the bonds, whereas in the loans, we have what's called a mandatory prepayment or an asset sale sweep. So the net cash proceeds from the asset sale in a loan agreement would be required to pay down the term loan debt, usually pro rata, without premium or other sort of fee, unless specifically negotiated. And there's often going to be what's called a reinvestment right, where instead of prepaying the debt, the company can instead reinvest in useful assets in the business. This is also an area where bonds and loans, you do need to look at how each instrument works independently. And if you're drafting these things, you got to make sure that they all fit together, because if you mess up one thing in one instrument, it's going to mess everything up, because then nobody's going to know where the proceeds are supposed to go when you actually do the sale.
Great. Scott and Ian, thank you so much for that presentation and taking us through the intricacies and demystifying bond and loan covenants for us. I do want to encourage our audience to continue to send in your questions using the Q&A feature on the screen. Just to get us started in terms of some of the questions, Scott and Ian, maybe from stepping back from a top-down perspective, have you observed a through line or direction in either or both loan and bond covenants over time? Is that something you've been observing or seeing?
Scott, you want to take that one?
Yeah, we have generally seen covenants getting more aggressive over time. And this generally just gives issuers and borrowers far more flexibility than you might expect. It really is a devil is in the details kind of thing, like Ian and I have kind of been talking about. And so sometimes it allows for actions that you might not expect, and really gives the issuer a lot of flexibility to move things around the structure, to kick the can down the road. You know, for example, in some of the most aggressive deals, we'll see, for example, unrestricted subsidiary investment capacity that could be 4 or 5 turns of EBITDA on the issue date. And this is capacity that the issuer could move to just strip value out of the credit for structurally senior financings, J-Crew type maneuvers. Really gives the issuer a lot of wiggle room. And so you really have to be thinking about these things that Ian and I mentioned, the covenants, you know, how each of the carve-outs are cumulative and independent of each other, to think about how much capacity an issuer has to make these kind of maneuvers.
Yeah, that's right. I think, and for loans, the trend line has perhaps been even more noticeable, simply because when the term loan B market really emerged right around the Great Recession, it was still kind of coming out from term loan A type covenant packages, which tended to be tighter. In the 15, 20 years since then, those covenants have gotten looser and looser. If you covenant review grades covenants, we assign a rating to each covenant package that we review, and if you look at the histogram of that, it's a very clear line where the covenants get weaker and weaker and weaker. And I think that's been pretty well established over the last decade or so. Ask any loan lawyer and they'll talk your ear off about why the covenants are broken or why they don't do anything anymore. But you know, Scott was making fun of me. Bondification is a thing where you take unsecured bond indentures covenant package and you literally copy and paste it into a credit agreement, and you change the word indenture to credit agreement, and you change the word issuer to borrower, but otherwise leave it unchanged. Things are going to kind of not work when you really dig down into it. Things like the prepayment, a junior debt prepayments covenant, or the fact that in a lot of bond indentures, unlimited value transfer within the restricted group is allowed because bonds used to be unsecured. But if you're a credit agreement term loan holder, you're secured. You don't want collateral being able to be moved from loan party to non-loan party essentially without limitation. And yet that's what a lot of modern day credit agreements will permit.
And those are some important considerations. Oh, go ahead, Scott. Yes.
Yeah, I was just going to jump in with one of the questions from the audience here on some of the material that we covered. Does the RP covenant cover only prepayment of subordinated debt? What about at maturity? So yes, the typical junior debt prepayment restriction is only about prepayment. Paying debt at maturity is not a restricted payment and not covered by the junior debt prepayment covenant of a typical loan. So really what a junior debt prepayment covenant is supposed to do is prevent debt that matures outside of the bonds or loans from being prepaid inside, right? It's really about maintaining temporal seniority. And so if you're in, let's say, a secured bond and there's existing unsecured debt in the structure that matures ahead of that secured bond, the issuer is allowed to repay it upon maturity. Typically speaking, the covenant typically establishes a window of 1 year ahead of the scheduled maturity of that debt to allow the issuer an appropriate amount of flexibility. So it's not like they can only pay it at maturity and they have to make a deal happen on that date. They typically have a year before the maturity of the debt where it's no longer subject to the RP or junior debt prepayment covenant.
Yeah, and one instruments, if one debt instrument were to block the repayment of debt at maturity of another instrument, there could be other issues that come up from that, including tortious interference.
Yeah, and I think it's fair to point out here that the issuer is always going to have to comply with the tightest covenant on that point. So in the bonds might be tighter on something, the loans might be tighter on something else. The issuer is always going to have to comply with the tightest restriction. Amending the bond indenture does not give a company any more flexibility under its loans, and typically amending the loans doesn't give the issuer any more flexibility under its bonds. They are separate documents. They must be amended separately by the investors in those instruments. So again, one more question related to this point: what would prevent the issuer from issuing sub-debt that matures earlier? Typically nothing. You can typically incur debt that matures inside of a bond. That debt would have temporal seniority. That's sort of the way the bond covenants work. Again, what the junior debt prepayment restrictions are really about is maintaining the temporal seniority, the way that it looks on the issue date. So typically speaking, it's about maintaining that order, and it's most important if you see secured and junior financing issued at the same time.
And some covenants in loans in particular will have will actually say you cannot amend junior debt documents if they're materially adverse to the existing lenders. In such a case, that could prevent that kind of backdoor to changing the maturity of the sub debt. Oh, I see one question on debt. Can we define accordions in more depth? Yes. So I didn't want to do this because it's a bit of a hairy topic, but accordions essentially are just another carve out and basket. We kind of treat it separately because it's probably the most important carve out and basket in a loans credit agreement. The accordion nowadays is structured in 3 main prongs. One is what we call a freebie or free and clear amount, which is essentially just a dollar basket with an EBITDA grower. Traditionally, this was around 1 turn of EBITDA, although now they can be much larger. The second prong is usually based on the voluntary prepayment of specifically first lien debt, but it could be other types of debt as well. And then the third prong is the same as a ratio debt carve out. It is an incurrence-based prong based on a particular being able to meet a particular ratio. In credit agreements, this is usually first lien leverage for the incurrence of pari passu first lien debt, secured leverage for the incurrence of junior secured debt, and either total leverage or interest coverage / fixed charge coverage for the incurrence of unsecured debt. And those are going to be sort of independent ratios, again, depending on what kind of incremental debt the company is trying to incur. What makes the accordion a little different from other baskets is that most of the time they're going to have something called MFN protection, which is designed to protect the trading value of the existing term loan debt. So the MFN says that if you're going to incur debt that's first lien secured, and essentially using all the same terms at the existing credit agreement level, but you want to slap on a really high coupon, that's going to have a negative impact on the trading value of existing term loan debt, because all else being equal, except for pricing, probably the investors are going to want the higher coupon term loan versus the lower coupon term loan. So the MFN says that if you're going to slap on a high coupon, the window between the yields of the new and the old debt can be no more than some negotiated threshold, usually 50 pips, but sometimes 75 or 100 pips.
So let's finish off with one last question from the audience here. Can you give your perspective on the substantially all provision for an IG company that spins off assets? So sure, that's a complicated question. So if it were a high yield covenant set, the spinoff would be primarily governed by the restricted payments covenant. Again, not just cash dividends, but spinning off assets is a non-cash distribution. That would be an RP. If we're not in a high yield bond, but instead in an investment grade bond, an investment grade covenant set is very skinny down compared to a high yield covenant set. There is no particular restriction on restricted payments or distributions of value to equity. So where the substantially all test comes in is it would be used in two places. One, in the change of control covenant, and two, in what we call the mergers covenant. Now, we call it the mergers covenant, but it's a little bit of a misnomer. Generally, it restricts the issuer either merging with another entity or transferring substantially all of its assets to another entity, unless the bonds travel with the assets. So the purpose of the mergers covenant is to ensure that the debt and the assets stay together. Now, whether a spinoff is going to be substantially all is a very, very difficult question to answer. As I said, there's no bright line rule. It's a facts and circumstances determination. Typically, a lawyer, and lawyers are risk averse, lawyers would not give an opinion that a transaction is substantially all unless it's more than 90% on every metric, and wouldn't give an opinion that something is not substantially all unless it's less than 30% on every metric. So there's a wide range in the middle. You know, the areas where it gets a little gray is when you start getting closer to that 90% mark, 70-80% of the assets. 50% is probably not substantially all, probably not going to be substantially all in most cases. It really does have to be the vast majority of the company. And we're looking at everything: assets, revenues, EBITDA, future prospects, everything, to determine whether there's a substantially all argument there. But it really does have to be on the upper end of all of these metrics to have a good, solid, substantially all argument.
One more question for me. For the debt covenant, is it possible to carve out any subordinated debt, like a hybrid structure, from the debt figure, even if it's booked as a liability in the balance sheet? I like this question because it really gets to, I think, something you really need to understand about covenants, which is you can put any basket in there that you want, right? You can carve out anything that you can imagine. So yes, you could absolutely carve out subordinated debt, which could allow for the incurrence of unlimited subordinated debt. And we've seen baskets that look like that. Often it's a little bit more limited. It'll say, the sub debt is owed to an affiliate or a holdco, or it can't mature inside of the existing term loan debt. But you could have a basket that just allows for subordinated debt. And from the perspective of a first lien lender, or really even a senior unsecured bondholder, you might be okay with that because it's always going to be behind you in the capital structure. Is it common to see a basket like that? No. But are they out there? Absolutely.
Great, Scott, Ian, thank you. Thank you, everyone, for sharing your questions. First off, thank you all for joining us today and for contributing your insightful questions to our discussion led by our two experts, Scott and Ian, on the topic of Covenants 101 Decoding Bond and Loan Covenants. The topic was certainly demystified further for myself. Everyone's questions, thank you. You helped truly enrich this session, and we hope the information shared by both Scott and Ian has been beneficial to your understanding of these relatively complex but very relevant day-to-day topics. Before we conclude, I do want to highlight where you can find some further resources and opportunities for ongoing professional development. First off, the Global Institute of Credit Professionals, who is a sponsor of today's event, offers a global credit certificate. That's its flagship qualification that's designed for individuals seeking a more comprehensive understanding of credit analysis and key decision-making areas in the realm of credit. It has a very comprehensive syllabus that covers various credit types and debt financing instruments, and it provides a relatively robust foundation for all credit professionals. Additionally, and you'll see to the right, for those interested in exploring covenant review further, you can visit the website to request a trial and gain a deeper understanding of the various research, analysis, and insights that Scott, Ian, and their colleagues have in various specialized sectors. So to access more information about both the Global Institute of Credit Professionals and Covenant Review, please scan the QR code or visit the website posted on the slide. And in closing, on behalf of myself, Scott, Ian, thank you everyone once again for your participation today. We look forward to connecting with you in our future events. Have a wonderful day.